Philadelphia Fed President Patrick Harker is saying the central bank should be done raising rates, and Wall Street seems to agree. 11% of interest rate traders are pricing in a hike at the Fed's November meeting. But what impact will higher for longer rates have on the economy? Joining us now is Ross Mayfield, Baird Investment Strategy Analyst. So Ross, I think I did lose track, Ross, this week of how many central bankers we heard from. This is a group, they like to talk, Ross, but we did hear from Patrick Harker. Says he believes the central bank does not need to raise interest rates again. Ross, let me get your take. What do you think with the Fed? Are they done with this rate hiking campaign?
I mean, look, their SEP still says they want to hike one more time. I know that's just a median dot plot, but I think their impulse is still, if there's upward pressure on inflation and there's upward pressure on the economy, to hike one more time. I agree with Harker. I think a pause is in order, and I think they should probably be done altogether. I don't think it's worth risking the economic momentum that we still have for an extra 25 basis points or a dogged pursuit of 2.0% inflation when something like 2.5 or 3 has been the historical norm. So I would pause. I probably would have paused a few hikes ago, actually, but yeah, I think maybe we can get a pause through year end and get some relief on rates. It could be beneficial for markets and for the economy.
Well, yeah, I was going to ask about the read through to rates, Ross, right? Because there has been a lot of debate over whether rates have peaked. And then whenever we sort of have that discussion, they go back up again, right? So I wonder when we can sort of expect that peak to happen, where it can happen, and then how much of a relief that could be for equities.
Yeah, it's tricky because the Fed controls the short end, and if the Fed decides they're done, the short end is probably at or near the peak. But the long end is much more kind of fluid. It's pressured by things like supply and demand, and we've seen that this intense amount of treasury supply is putting upward pressure on rates. It's influenced by the economy and inflation. So if inflation is a little sticky and the economy is a little resilient, that puts upward pressure as well. If there's a rush to safe haven assets like we saw at the beginning of the week, you could see downward pressure on rates. But I think the overall trend is still higher for longer at the long end of the curve, which is something that the Fed controls to an extent, but not nearly as much. So I really think you need relief on both to get a real broad and sustainable equity rally. But it can start with the Fed, and I think them, coming out and saying things like they should stop, maybe talking about when or what might implement cuts in the next year, give the market a little bit of reprieve, could be the first step for equities kind of sustaining a bull market. But it'll take more than just the Fed, because the long end is where a lot of the pressure has been in the last couple of months.
What about geopolitical risk here, Ross? I mean, the war between Israel and Hamas. How do you think Jay Powell and our policymakers are thinking about that?
Well, look, obviously a terrible human tragedy going on over there. Chair Powell and the Fed, I think they'll probably look through an event like this or give it some weight, but not as much weight as, say, the domestic economy or the domestic labor market. They've made comments about gas prices and oil in the past, which I think is the primary upside risk here. They tend to look through that. It's why they like things like core inflation, because they have so little control over, energy and food prices. But they've also said that, if there's a shock at the pump and consumers incorporate higher gas prices into their inflation expectations, it can kind of feed the inflationary beast, and the Fed would have to respond to that. So it might add a little bit of complexity to their job, but I think that they'll remain focused on the domestic economy first and foremost. I think that's what you're likely to hear from them if they comment going forward.
So we have been talking about bank earnings here today, and obviously we're at the beginning of earnings season. What kind of catalyst is this going to be for stocks? Are we going to see stocks higher at the end of earnings season?
I think you could. I mean, we've had this kind of gap of catalysts, and so it's been higher rates, higher oil prices, and it's pressured equities. You've also had a big seasonal headwind through the end of the third quarter. Earnings have been positive, or at least better than expected the past few quarters. I think we're set up for another strong quarter. Financials are kind of challenged by some idiosyncrasies that, are still stemming from the higher rate environment and some of the challenges last March. But things so far have been pretty resilient or pretty good. And I think we're setting up for an earnings season once again where expectations could be beat, where guidance could be good enough to put a floor under the market. And I think you're going to see some of the trends that we've been talking about, but haven't been in focus the last few weeks and months because of the focus on rates, because of the focus on oil prices, because of the focus like a stronger dollar. I think earnings can be a real catalyst for the market here. And I think early this week, we've already started to see that a little bit.
Ross, final question. I'll get you out of here on this. I know you're focused right now, you said, on higher quality cyclicals. What does that mean exactly, Ross? How are you screening for those names?
Sure. So higher quality is the theme for us right now. You know, in a challenged macro environment, you might typically turn to defensives. They haven't really caught much of a bid over the past couple of months, primarily because as yield proxies, they struggle in this high rate environment. And so what do you do if the macro is challenged? Look for high quality. You can be sector agnostic. You can even lean cyclical if that soft landing is your base case. I mean, the economy has been really strong. Q3 GDP is going to print really well. So cyclicals are not a bad place to be. Energy in particular has been really strong. But, you know, higher rates, higher inflation, we want to focus on quality, looking at things like free cash flow growth, looking at things like margin protection, you know, going old school, looking at things like quality management teams that might have seen an environment like this before, because it's been a decade plus since we've seen something like this. So, you know, looking for kind of those classic high quality, you know, traits in both the equity markets and the fixed income markets, because while we do like the soft landing narrative here, there are enough macro headwinds to make us not want to chase in some of the more speculative or risky stuff out there.
All right, a voice of calm. Ross Mayfield, thanks so much. Have a great weekend.
You as well. Thank you.